Hi everyone, in this video we're going to go over top 20 best recession-proof dividend growth stock. Now this is continuation part of part 1, so if you haven't watched that yet, you can click the link right here. Now, all this company right here, I got from this article from Simply Safe Dividend. This company will have 3% yield higher, stable business model, solid balance sheet, and proven commitment to maintain and growing that dividend in all manners of economic, industry, and interest rate conditions. Each stock also meaningful outperformed the S&P 500 during the financial crisis. Now, this article was written before the coronavirus crisis and the oil war going on, so a lot of fundamental had changed. So I'm gonna also give you my personal opinion about each company in this article. And if you find this video informative, please click the like button, click the subscribe button. That would help out my channel a lot and I would really appreciate it. The first company is Chevron, ticker CVX. Chevron is one of the world's largest integrated oil giant and also dividend aristocrat. During the last recession from 2007 to 2009, S&P 500 lost about 55%, Chevron only lost about 34%. Chevron currently have dividend yield of 6.76 with the dividend safety score of 65, which is considered a safe. Last year, Chevron grew its dividend by 6%. The 5-year average growth rate is 2%. The 20-year average growth rate is 7%. Now, by looking at Chevron chart from 2014 to 2016, you can see a sharply decrease in share price of 45%. Now, the reason for that is during that time, the oil price actually crashed. It's pretty similar to the current situation. During the oil price crash from 2014 to 2016, for example, Chevron drillings expand by 50% and management believe that it can get the figure down by 80% by 2020. Now, if you look at the crude oil price chart right here, before the drop in 2014, the oil price actually at the $120 mark. That means even Chevron able to cut their drilling expand, like they say, by 80%, they still barely profitable or even maybe go negative. The earning per share for Chevron is pretty choppy because it does depend on the oil price. As you can see in 2014, 2016, the earning for Chevron actually decreased drastically. And recently, they just barely recover and now we just have the oil price cut once again. The next 12 months, they only expect $1 earning per share. Actually, I expect it to be worse in the negative territory, to be honest. And 2014 and 16 is not that far away, so the company barely able to recover. And yet again, we hit it with the oil war along with the coronaviruses. I think overall, the oil and gas industry can be extremely risky in a short term or even medium term. And if I want to invest in this sector, I would rather invest in MMP. Like I said in the last video, MMP is more toward oil and gas storage and transportation, so I think it's less risky than the production company. The second company is Exxon Mobil, ticker XOM. Exxon Mobil is one of the world's oldest oil company. The firm has evolved from regional refiner and distributor of kerosene used in lamp to largest public trade petroleum and petrochemical enterprise in the world. During 2007 to 2009, the S&P 500 lost 55%, ExxonMobil only lost 28%. They currently have dividend yield of 8.96 with a dividend safety score of 55, which is considered as borderline safe by safety dividend. Last year, it grew dividend by 6%, the 5-year average is 5%, the 20-year average is 7%. ExxonMobil price chart looked pretty similar to Chevron, but a little bit worse in the recent year. Now, overall, the share price appreciation of Chevron is much better than ExxonMobil. The earning per share for ExxonMobil is actually worse than Chevron. It actually showed that more noticeably in the downward trajectory, and in the next 12 months, the earning per share only expect to be 0.61. I even expect to be in the negative territory, like I said before about Chevron. The free cash flow of ExxonMobil also worse than Chevron. So yeah, with those facts, it does show in the share price why Chevron been performed better than ExxonMobil overall. But still, I would not invest in the oil and gas industry in this moment, except for MMP if I consider. The next company is Consolidated Edison, ticker ED. Consolidated Edison is a regulated electric and gas utility serving in New York metro area. Over 90% of the company's earnings are derived from the regulated activities, provide a predictable, fairly reasoned, recession-proof earning stream. During 2007-2009, the share price of ED only lost 26%, and ED been growing dividend for 26 consecutive years. ED currently had dividend yield of 4.03 with dividend safety score of 90, which is considered as very safe by Simply Safe Dividend. Last year, it grew dividend by 3%. The 5-year average is 3%. 3%. The 20-year average is 2%, so it's pretty slow at growing its dividend, but at least been growing dividend for 44 consecutive years. Actually, 45 years by now. My thought about ED go align with this article right here. Consolidated Edison business benefit from the monopoly-like status is enjoyed in the service territories. Following industry-wide restructuring in the 1990s, all of the electric and gas delivery service in New York is now provided by just 4 investor-owned utility, all one of 2 state authorities. Management target a rather conservative payout ratio for utility between 60 and 70%, which should further ensure the dividend safety during the next recession. So if you're looking for a stable utility company that will not cut the dividend, ED is a great choice. But honestly, for the utility sector, I'd rather pick WEC for a few reasons. ED been growing earning per share pretty consistently, but the growth rate for earning per share actually is only around 1% as recent rate. Where WEC, you can see a clear uptrend of the earning per share growth. And you obviously can tell that by the earning per share percentage growth. Now, even though 4% and 7% is only 6 to 3% higher than ED, but we all know the power of compounding. And you can clearly see that from the price appreciation of each company. ED from the bottom of 2009 recession until the recent drop, the share price appreciation is only around 184%. Where WEC from the bottom of 2009 until before the recent drop, it actually have a gain of 500%. And as you can see, WEC chart look much less choppy and more toward an upward trend compared to the ED chart. And as Benjamin Graham explained, in the short run, the market is like a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is like a weighing machine, assessing the sustain of a company. So yeah, the share price performance does tell you how the market assessing the company. And we can clearly tell WEC performed much better than ED in terms of price appreciation. So yeah, I much prefer WEC over ED. Move on to the fourth company, PepsiCo, ticker PEP. PepsiCo is one of the oldest and largest drink and snack maker in the world, selling dozens of brands in over 200 countries and territories. The company owns 22 iconic brands such as Pepsi, Gatorade, Tropicana, Lay's, and Quaker, which each generate over $1 billion in sales. During the last recession from 2007 to 2009, PepsiCo's share price only lost around 35%. It currently have dividend yield of 3.18%, and its dividend safety score is 93 by Simply Say Dividend, which consider us very safe. Last year, grew dividend by 6%. The 5-year average growth rate is 8%. The 20-year average growth rate is 10%. So it's growing a dividend at a pretty fast rate. And it's been growing a dividend for 47 years throughout multiple recessions. And 3 more years, it will be considered as dividend king with 50 years of growing dividend consecutively. PepsiCo wide moat is courtesy of strong brand built up over more than 100 years of steady advertising. The firm owns the top 7 salty snack brands and claim that 90% of its retail sell from brand with number 1 or number 2 subcategories share position. PepsiCo's share price performed pretty well. It on an upward trend with minor pullback here and there during recession. With the recent crisis, I do not think it will affect PepsiCo that much compared to most other companies, and it has shown in its share price. With the recent pullback, PepsiCo is only 15% from its all-time high, and it's been growing dividend for 47 years, which means it's considered as dividend aristocrat. And just 3 more years, and it will become a dividend king. And who doesn't want to be a king? So yeah, I expect PepsiCo to continue growing dividend even if we enter recession. It's for sure a recession-proof dividend growth stock. The next company is KimberlyClark, ticker KMB. KimberlyClark is time-tested consumer staple behemoth, selling name brand products such as Cottonelle toilet paper, Scott paper towel, and Huggies diaper over 175 countries around the world. Emerging market account for 30% of the sales. During the last recession from 2007 to 2009, KBM share price only lost 34%, and it currently had dividend yield of 3.45% and the dividend safety score of 88, which is also considered as very safe. Last year, grew dividend by 3%. The 5-year average growth rate is 4%. The 20-year average growth rate is 7%. Just like PepsiCo, KMB been growing dividend for 47 years, so just 3 more years it will become a dividend king. Due to its strong portfolio brand, KimberlyClark command number 1 or number 2 market share in 80 countries and enjoys wide moat thanks to retailers giving it fast-selling product preferred shelf space. Combined with the hundreds of millions of dollars the company spend advertising and research and development each year, this market is challenging for rival to steal itself. With the current crisis situation, I do not believe that it will affect KimberlyClark that much because it's mostly selling household essential item which we well need, especially toilet paper. And it clearly shows show in the price with the current pullback from an all-time high at the current moment is only 15% compared to the rest of the market where it's down more than 20 to 30%. The only thing I do not like about Kimberly-Clark is its sell growth. It's pretty flat and some year negative. Even though the earning per share price is still growing, its sell growth from 2012 until now is either negative or pretty much close to zero, which means the earning per share continue to grow is because of them cutting down costs or share buyback program. And you can clearly see that by its share outstanding decreasing year over year. And you only can cut down costs by so much, so it's not a great thing either. I forgot they also can increase earning by raise their price. But overall, I think Kimberly-Clark is a very safe dividend. It will continue to grow its dividend during recession to become a dividend king, but I'm just a tad bit worried about its future growth. The next company is Leggett Platt, ticker LEG. LEG is over 135 years old and have built itself into a leading global provider of components used in bedding, furniture, carpet, automobiles, aircraft, and other products. During the last recession from 2007 to 2009, LEG share price only lost around 44%. LEG currently have dividend yield of 5.28 with a dividend safety score of 61. Last year, LEG grew its dividend by 5%. The 5-year average growth rate is also 5%. The 20-year average growth rate is 8%. LEG continued to grow dividend through multiple recessions with 48 years of consecutive growing dividend. So just 2 more years, it will become a dividend king. LEG built over 1,300 patterns that give it strong pricing power with customer. LEG able to control its cost much better than smaller peers, which is why during the Great Recession, despite near 30% decline in revenue, the company was able to grow its free cash flow per share, providing a nice protection for its dividends. Now, honestly, I do not know much about this type of business, but you can tell from the chart that this business is very cyclical. You can tell that from the very choppy price action. And during the recent pullback, it actually pulled back close to 60% from its all-time high. From the price action in the chart, LEG seemed like much more volatile than this article claimed it to be. Now, during this recession, LEG probably still gonna continue to grow its dividend since it only needs 2 more years to become a dividend king. And you can see its effort in growing the dividend by looking at this earning payout ratio. Even though in 2010 and 2011, a payout ratio of close to 91 to 98% is still to continue to raise its dividend. But overall, by looking at price action performance, I think there are a lot more stable company out there that I would rather put my money in. And it doesn't seem like recession proof like this article claimed. The next company is Altria, ticker MO. Altria is the American largest tobacco companies command dominant market share as a result of portfolio and leading cigarette brands. During the last recession from 2007 to 2009, Altria's share price only decreased by 20%. MO currently have a whopping dividend yield of 9.17% with a dividend safety score of 55, which is borderline safe. Last year, MO grew its dividend by 9%. The 5-year average growth rate is 10%. The 20-year average growth rate is 3%. MO been growing dividend throughout multiple recessions with 50 years of consecutive dividend growth and is considered as dividend king, the first dividend king on this list so far. Altria earning per share been growing at a pretty good rate, but the sale growth only increased by 1% since 2017. But I have heard that Altria been continue to raise their price since basically they are monopoly with more than 50% market share. Altria showed a great price appreciation from 2009 until 2017. From 2017, it continued on a downward trend. It probably had to do with the stagnant sale growth and a few recent drama about vaping. Fundamentally, what makes Altria potentially great recession-proof stock is that its customers are extremely brand loyal and continue to buy product no matter the state of the economy. This gives a business a very strong price power. Historically, the company has raised its cigarette price by 4 to 5% annually, which is how Altria is able to slowly grow its revenue despite the steady volume decline in the US cigarettes. As you probably can tell, the cigarette business is very sticky business. The only thing to consider during this crisis, since the coronavirus does affect the respiratory system, the government may try to ban it. I'm not sure, but it could be. If you like high yield dividend stock and don't mind the risk, Altria seems like a pretty good option. The next company is CocaCola, ticker KO. Coke is the world's largest beverage seller, marketing over 3,900 products, under 500 brands in more than 200 countries and territories, via 24 million retail markets. The company owns 21 brands that generate over $1 billion in sales. During the last recession from 2007 to 2009, Coke share price only decreased by 31%. It currently had dividend yield of 3.7 with the dividend safety score of 80 by Simply Say Dividend. Last year growth dividend by 3%, the 5-year average growth rate is 6%, the 20-year average growth rate is 8%. It's been growing a dividend through multiple recessions with 57 years of consecutive dividend growth. Now since Coke and Pepsi basically in the same beverage business, I'm going to compare them too, and I do prefer Pepsi over Coke as a company. Now if you look at PepsiCo earnings per share growth, it's been growing earnings per share by 42% in the last 10 years, where earnings per share for Coke in the last 10 years only increased by 27%. Now the sales growth for Pepsi only had one negative down year in 2015, and from then it's able to stay consistent from 0 and to 4% sales growth increase, where Coke had multiple negative down years since 2013. Even with this 9% sales growth in the last year, I don't think it's gonna make up for that many years of negative growth. Now you can see much clearer in this picture. This is Pepsi revenue from 2006 until now, and this is Coke revenue from 2006 until now, and you can clearly see that from the price action chart of Pepsi versus Coke. This is Pepsi monthly price chart with a clearly uptrend with the minor pullback here and there during the few recent correction or recession, where Coke price is much more choppy and actually increase in value share is much slower compared to Pepsi. Pepsi with the lowest pullback recently is only 30%, where Coke recent pullback is closer to 40%. So you can clearly tell that investor does value Pepsi more than Coke. Plus Pepsi does have a faster dividend growth rate. Now even though it's only a few percent, but we all know that compound dividend growth matters. The ninth company is Johnson & Johnson, ticker J&J. J&J is the largest global medical conglomerate with over 250 subsidiaries operating across more than 60 countries. The firm's three business segments provide with a very diversified mixed revenue, earning and cash flow. However, the pharmaceutical division is the largest contributor, accounting for over half of total pre-tax profit. During the last recession from 2007 to 2009, the share price of Johnson & Johnson only decreased by 27%. Currently, it have a dividend yield of 3% and it have a dividend safety score of 99, which is high as it's get. Last year, it grew a dividend by 6%. The 5-year average is also 6%. The 20-year average is 10%. Johnson & Johnson been growing dividend through numerous recessions with 57 years of consecutive dividend growth. And you probably heard that a lot of people use Johnson & Johnson as a parking lot to go and park their money there. And there are multiple reasons why. The firm revenue is number 1 or number 2 global market share position. Over 20% of sales are also from new products launched within the past 5 years, highlighting the company's ability to continuously innovate and adapt. During recession, consumers still need to have their medical issues treated. As a result, Johnson & Johnson sales only declined by 6.2% during the financial crisis. Management continued to raise their dividend and the company's stock lost half as much as the broad market. With one of the strongest rating and companies in America, a cash hoard on its balance sheet and payout not far from its pre-2018 level, Johnson & Johnson remained dependable recession-proof stock. And you can see the earning per share on a very nice upward trajectory. And you can tell the price action of Johnson & Johnson is pretty good. During the last pullback, most stock dropped more than 40 to 50%. Johnson & Johnson only dropped around 28%. So yeah, with the recent crisis, I don't think it can affect Johnson & Johnson that much. It's probably one of the safest stocks out there right now. The next company is Procter Gamble, ticker PG. Procter Gamble is one of the world's largest consumer staple companies, selling 65 products over 180 countries. Its strong portfolio of brands include 21 products which generate over $1 billion in annual sales. During the last recession from 2007 to 2009, P&G share price only lost 38%. It currently had dividend yield of 2.78% and a dividend safety score of also 99, which is the safest. Last year, P&G grew a dividend by 4%, 5-year average is 3%, the 20-year average is 8%. It's been growing dividend for a whopping 62 consecutive years. In a recent year, Procter Gamble had gone under a major reconstruction, selling over 100 of its smallest, least profitable brands to refocus its investment on its strongest, most profitable one. As a result, the business was able to reduce costs by $7 billion. These strong brands give the industry leading market share in the product that consumers buy no matter what the economy is doing. As long as P&G continue to invest in R&D to stay on top of evolving consumer preferences and invest in the right advertising and distribution channel, a business should remain a force for many years to come. With the current crisis, it's probably not going to affect P&G that much, especially a lot of people are stocking up on a lot of household essential goods. You can clearly tell that by a price action chart. At the lowest point, it only dipped by 26% from its all-time high compared to the rest of the market dipping 40 to 50%. And right now, it's only around 16% from its hit all-time high. So it's pretty much a recession-proof dividend stock during this financial crisis. So yeah, that is the end of the list. Let me know what is your favorite stock in this list is. Thank you guys for watching until the end. If you can help me out, click the like button, click the subscribe button, turn on your notification bell for more videos like this. Again, my name is Kyle, your average investor, and you guys have a blessed day.